Welcome to the Block Time podcast, produced by Riot Platforms, where we take a deep dive into Bitcoin, Bitcoin mining, and the grid. Today, we're really going to be focused on all three, but especially the grid, because we have an electricity grid expert here, Shaun Connell from Lancium. Welcome, Shaun.
Great. Thanks for having me, Pierre. Happy to be here.
I'm excited to have you. I feel like I've been wanting to talk with you for a while now because, I mean, you're a wealth of knowledge in this area. And there's quite an intersection with the ERCOT market and Riot's activities in this market. So I guess first I want to start off with kind of your background, your journey into this space.
Sure. Well, happy to be here. And I've listened to some podcasts yours in the past, so happy to have conversation as well. So my journey here, kind of starting with like, how did I get involved in kind of like the Bitcoin space, was that I've worked for a power generation company for many years, started around just when power markets were becoming deregulated. And what that meant was instead of power companies having like a customer that had to buy your power at a certain price, right? Deregulation meant that they had these generation assets and they needed to kind of find a home for their megawatts. And so what they needed to do was they needed to build trade floors. And the trade floor purpose was essentially kind of how do you capture the most amount of value from your generation? So it's either kind of like selling to commercial industrial customers, selling into forward markets, but essentially when power markets are being deregulated, it was really a lot of unknowns and kind of like reminds me of kind of what we're going through in kind of Bitcoin mining. So my journey started in power and kind of worked in power generation and kind of did that for 20 years, helped lead and build a trade floor. The company I worked for was called TransAlta. Generation assets across the United States, Canada, some in Australia. And so being on a trade desk is that, the way I got into Bitcoin or kind of heard about it was that, we're looking for different ways to kind of add value to a trade group. And we're looking at some of these generation assets and saying like, well, we've got some assets that are, fully contracted or not fully contracted and not being fully utilized. So like, what is another way that we can actually get more value out of these assets since they're just kind of sitting there and it's kind of like, kind of like an ice cream cone. It's kind of like melting ice cream cone. It's just going away. You don't get it back. And so that's kind of like power generation. You either can produce the megawatts at that time or you don't. And so the journey became down the path of saying, Bitcoin mining started to surface, right? And it came up through a friend of mine back in 2017. He gave me the narrative about, digital gold, and I kind of really, bought into that. And for me, is like as I dove down the rabbit hole a little deeper, you realize it's like mining is just a commodity, right? And we're producing hash rate the same way as generation produces megawatts. And so for me to really understand Bitcoin, I needed to come at it from the mindset of it's a commodity, right? And so when I talked to him, as I said, well, what is the cost for Bitcoin? And he said at the time it was like $8,000 in 2017. It was on the slope up in November 2021. I said, well, how do you get it? And he says, well, you can actually, can buy it or you can mine it. And it's like, okay, well, how do you mine it, right? And went through kind of, we have these computers or these servers, and so that was like, okay, well, what does it cost to mine Bitcoin? And he said, I think it's like $300. And I was like, uh-oh, because that's a break, right? That's like, $10,000 Bitcoin or $8,000 Bitcoin, $300. So like either the price has to come down or this has to go up, right? But in commodity markets, all things converge. And so I went down that journey of kind of understanding Bitcoin mining. And then with the company that I was working for, I was saying, like, we've got these assets, there's this commodity, and knowing that you can actually produce this commodity and then sell it for a higher price, we were looking at, ways to kind of say, like, how do we kind of pair this with existing generation assets to have kind of behind the fence mining and actually kind of, produce the Bitcoin. And then you've spent the last 20 years building a trade floor that's capable of essentially capturing the most amount of value from your assets. So you're really well positioned as a power company to put Bitcoin miners behind there because you can treat it the exact same way you do as power generation. And so you're capable of really kind of monetizing that. So long story short on that was we were going down that path. COVID happened and, essentially only kind of the essential projects were being done. And so things that were kind of looking at some other initiatives were put on hold. I was really, really fascinated by the Bitcoin part. And along that journey, I came across Lancium because we were looking to fabricate some containers And we're like, how do you do this, right? We're trying to put together the pieces. And we went up to, there's a place in just outside of Edmonton where they do fabrication. And we went up there because we heard a lot of folks had done containers there. And we went up to them, told them what we were trying to do and put these containers there behind the fence. And they said, hey, listen, you guys sound like you really understand the power space, but the people that we've been talking to that really understand kind of these containers and, we think are the smartest guys in the room is Lancium. You should probably call them and kind of see if they can help you, right? And so we went down that path, and we were looking to consider having them saying, like, we need help with controlling these miners, and how do we treat them like a power plant? And so I had conversations with Lancium. Project was put on hold, and then, I want to continue down that path. So in 2020, made the switch over and leaving kind of power generation of 20 years and saw this really big opportunity that like Bitcoin miners are going to have, which is like, how do you integrate these into power grids and treat them the same as like a power generator, but in reverse, right? And so instead of managing kind of load with incremental power, you're actually doing it with reducing the demand and really having kind of like, and this is what's different, is like this dial switch, right, which is Lancium has, is like they can actually control it with precision and speed to get the exact output that you need, which allows you to really kind of integrate with the grid versus just having something that's kind of like retail grade type of demand response, but like really, ISO, like system operator grade that you can participate in all their markets. So long answer, but that's kind of how
No,
I
it's
got into
fascinating.
it. Yeah.
And on the power generation side, I think that when I hear people talk about power generation, sometimes if they're not in the industry, they kind of look at it through one dimension. So they're going to choose one metric, and they're going to decide if a power generator is good or bad based on that metric, right? So it might be uptime, right? So they'll see like, oh, this nuclear plant is on 100% of the time. That's great. We should only have nuclear, right? Or they'll look at wind, and they'll say, well, look, when the wind's not blowing, you're not producing any electricity, so we shouldn't have any wind. Or when they look at natural gas, they'll say, well, you've got carbon emissions, like we can't have any natural gas. So like there's always like one metric, but really like if we abstract away from kind of that conversation to the financial side, I find that quite often these can just be thought of as financial models of it's an options contract. You have the right to turn on, or, based on the spread. Do you want to get into like how power generation is looked at from a financial perspective?
Sure. Like there's lots of different ways, and there are different metrics, right? And it's, what is the emissions metric, right?
Yeah.
Which can kind of skew things, or kind of like what is the overall profitability. But I'd say that like, an example is for like a gas plant, right? As there are renewable sources and there's fossil fuel sources. And we all know that renewable sources are abundant, right? You can kind of bring online, they're very cheap, they have no marginal cost, but you can't kind of rely on them for when they're coming on and when they're coming off. We know the sun's gonna be there a certain time, and wind is kind of less kind of a shape. But on the gas side is that you have different types of natural gas plants, and they're usually measured in a heat rate, right, which is their efficiency. And it's not necessarily that you want to have just like the lowest heat rate plant is the best solution, because sometimes you want to have a plant that's in a certain market that has a lot of price volatility, and you don't want this thing all the time, but you want it to be able to come up very fast to be able to capture those kind of high prices, right? So like in the natural gas space is like a really efficient natural gas plant is called like a combined cycle, produces steam as well. We'll have like a 7 heat rate. And so what that means is that you need to use 7 units of gas to produce 1 unit of power. And so in the current gas environment, which is, call it like $3 an MMBTU, which is the unit of gas, you can produce power for $21, which is really cheap, right? Yeah. Less efficient natural gas plants are kind of like, they call them natural gas peakers. They're in kind of like the 11, 12, 13 heat rate, which is still cheap. But in an environment where you're in high price gas, which we just came out of from like a year and a half ago, gas is coming up to $10. So like that 7 heat rate plant was actually $70, and that 13 heat rate was $130. So a common metric is like their heat rate and their marginal cost. But it's in power, it's really hard to do kind of like an apples to apples comparison, because you have something like nuclear, which is near zero marginal costs, right? But the really, really high regulatory costs, maintenance costs, really upfront costs, right? So the example is like, buying a combustion engine where you're actually having to refill your gas all the time versus an electric car, and maybe you're paying more for the electric car up front, but you're not using actual, cheaper on your fuel costs.
Yeah.
Right. So it's a very, large depends.
Yeah, because then there's are you financing it with debt, or it's like all of these other questions on the balance sheet for how to make the asset work.
Mm-hmm.
And on the price volatility side that you mentioned, um, it seems like price volatility sometimes is due to intermittent generation not being there. There's no wind, there's no sun. Other times, it's just that demand is so great that it just outpaces any kind of generation. And maybe that's particular to Texas because of our situation.
Yeah. If you kind of go back to when deregulation happened around 2000, around the year 2000, and at that time is that the grid there was no renewables, right? There's no wind, there's no solar, and it's just all fossil fuel generation. And essentially, the grid operator was just responsible for forecasting demand and then just matching the generation that they'd have at that time, right? So at those times is that there's less volatility in the market, right? Because you've got like a generation stack of kind of, how much, coal plants you have, natural gas plants, nuclear plants. And so you're kind of managing those. And so the price spikes would happen from something like a nuclear plant tripping offline or some large plant coming offline. And having to kind of dispatch something up and not having it available, so you can have these price spikes. From 2000 to 2020, we were also going through a very, called 2018, slow load growth. There was a lot of offshoring of demand in different locations that were happening. So other locations in the world, their demand was going up into, to the top there. And in the U.S. and Canada, it was kind of flatlining to growing like 1% or 2% per year. And so you're in this very calm era of like, your summer peaks weren't kind of blowing out past kind of forecast. And then you kind of layer on this, hesitant to kind of use the words like climate change, right? It's just like the climate change of kind of like you're having more volatility in weather that's actually kind of blowing past kind of previous kind of peaks. So, punchline on this is like in the early stages of deregulation, right? There's less volatility, there's more certainty on your generation. Fast forward to the last 5 years, is that like we have way more wind and solar. Like in ERCOT, I think last year, like 35% of all generation was from wind and solar, which is a massive amount. The grid operator now isn't just forecasting demand, they're actually forecasting something's called net load, which says what is the wind and the solar expected to do and how much generation do we have to meet that. So they're actually having to forecast wind and solar, and any type of, kind of variance or misforecast on that can have really large impacts. And I'll use an example of like in, the time frame of March and April, when there's, less load on the system, you can have a lot of wind and solar that's making up all the demand. But if you have no actual fossil fuels that are generation online to actually kind of, be called on that's online that can just turn up quickly, you can have these really large price spikes happen because you actually don't have the generation online. You have to call on them or start them up. So we're in this new era of kind of volatility that's kind of, apart from kind of like weather, apart from, we're bringing load back to our North American power grids, coming through kind of new 21st century workloads that are flexible, like Bitcoin mining, hydrogen electrolysis, AI data centers. But we've seen this, this turbulence, and so like it's fresh in our minds and kind of what's happened.
Yeah, it's fascinating. You mentioned deregulation. When I started learning about electricity grids, I thought it was really interesting that they started out kind of as natural monopolies due to network effects of setting up, all these transmission lines to people's homes. Mm-hmm. And then they became regulated monopolies. And then with deregulation, they're kind of creating artificial markets, right? Where previously it was like one entity. Now we're trying to unbundle all of these services and getting the design right. It seems like in some jurisdictions, they do a better job of getting the design right for deregulation to make sure that you're delivering reliable power at the end, kind of what the consumer sees. And I've heard, obviously with Winter Storm Uri, people have had their criticisms of ERCOT, but I've also heard tremendous praise for how well structured and it's not so much that it's deregulated in Texas, it's well regulated, is what I've heard. Do you think that that's the case when you look comparatively across different jurisdictions?
So I think, like, as with most things, everything is very much path dependent.
Yeah.
Right. So like electricity comes to U.S., Canada, it's like 1890, right, time frame. And so like, how does that start and kind of start to evolve? And there's different companies competing for sending wires, so they need to kind of regulate that. And so like, what was that patchwork that kind of progressed? In 1933, they came up with the New Deal, which essentially kind of like bringing power to kind of rural areas. And what were the impacts on creating some kind of government agencies that are responsible for delivering power? And so I think that, you take the Texas, for example, Texas, fortunate or not, like the way that the grid works here is that, like, since they don't actually have kind of like they're not connected to the rest of the East and West interconnect in the U.S., right? There's 3 different power grids in the U.S. There's the West interconnect, the East interconnect, and ERCOT. So since there's no actual kind of like interconnection that's happened to those, there's no across state business. And so they were actually allowed to kind of not be part of the FERC system, right? And so it's almost like Texas is an island, right? And they control the actual, at the governance is kind of done at the state level. And so they're able to design the market in one state and kind of, what should be the rule set. And so in Texas is that they're fortunate here that they have a deregulated wholesale market where generation loads can participate in these markets for providing like ancillary services, generation. And then on the retail side is that customers have a choice of who their energy supplier is. They're not just stuck with who the utility that's servicing you there. So it's kind of like there's 3 separate businesses. There's the retailing side of the business on who kind of gives your energy bill. There's the wire side, which is very regulated because you don't want to have 40 companies putting power
Building the
lines.
same wire,
Right?
yeah.
And then there's your wholesale market, right, which is, ERCOT, the grid operator, is running essentially like a competitive auction for providing the lowest cost energy that's reliable with all types of resources and agnostic of the resources, right? Because they just need to meet like a certain kind of, technical capabilities to qualify to participate in that market. So linking to some other markets where there's, we'll call like PGM, which is in the Northeast, and MISO and more in the center of the country, and SPP, is that these competitive wholesale markets span across multiple states. So you're designing market rules across markets, different states, which can have some kind of, challenges from kind of one area to another. And then in those areas is you're going to have like a blend of kind of like there's an actual utility company that's still there that owns the meter, right? That's a monopoly structure in a competitive wholesale market. So really kind of there's a real hodgepodge of kind of different combinations of competitive and not competitive retail and wholesale markets. And Texas is fortunate that it's all under one control, and I think it's a very well operating market.
Yeah, that's fascinating. And when we look at, some people say, hey, look, like the Texas grid would be more stable if it was interconnected. And do you think that there's truth to that, or that might be a little oversold?
I think there's a lot of truth to that. There's the grid operator, right? Like if you're in the control room, it's like you want to have like a tool belt of a whole bunch of flexible resources, right? Things that are the levers that as kind of like demand and generation is changing, you need to balance the grid. So you want to have as many levers as possible, right? So typically there's been, the first lever is your generation, right? And so that's kind of like your fossil fuels. So saying you can call on those and bring those up whenever you want. Another one is storage, right? So either kind of like hydro storage or battery storage. So you want to have a full lever of those ones. The third one is interties, which is this example here, and I'll come back to that a little more, but like it's a very important piece. And the last one is your demand response, right? So like what are your loads capable of pulling so that you have these? So as a grid operator, like you want to have a full suite of these tools. In Texas, we're transitioning away from coal plants, and so there's a lot of natural gas still, but the wind and solar, I mentioned like 35% of the energy last year, it was taken away from the coal and the natural gas market share, right? So you're in this path of retiring fossil fuel plants, which is a big shift. And so the grid operator can't count on those resources for doing so. So they need other levers, right? And so the next one was storage, and there's virtually zero hydro storage in Texas. but a growing amount of batteries. So a couple of years ago, it was near zero, and that's moving very fast. So grid operators are very happy with having additional storage for kind of managing those. Demand response, like that was very low before, and like it's moving very fast, and there's different types, and we can probably dig deeper in those after. But to your question on like the interties, is like there's a massive amount of power that can actually flow between the grids. So like if we are in a situation of like, coming up on like a near scarcity power, we've only got call it less than a gigawatt of power that can go across these lines that are on these DC ties, so direct current ties. Whereas if you had free flowing kind of megawatts that come across there, what would happen is, use an example of in Texas, if we're in the springtime and the system load is 50,000 megawatts, so 50 gigawatts, and if we lose a gigawatt of generation in Texas, that means that the frequency of the grid is going to change because there's less power generation being produced in the same amount of load. And so ERCOT needs to procure these flexible resources that can be called on to address that frequency response immediately. You cannot have that frequency drop to a certain point, so it has to be addressed. If you have these connecting ties from other regions, essentially the frequency shift is now going to be pulled on these other ISOs that could have 400 gigawatts that are online, and so that shift isn't going to really even be noticed at all,
right?
Because you have this baseline of other generation in other areas that you can draw upon,
supporting the grid. Yeah.
So it's a very important lever.
That's very interesting. So you mentioned batteries, and there has been a huge growth of batteries, so much so that ERCOT added it to their dashboard. Right now, you can see when they're charging, when they're discharging, which I find really interesting to compare it to our curtailment activities, right? But in terms of kind of people looking at the ERCOT market, another point of concern I've heard is this distinction between ancillary services, energy, and capacity, and that ERCOT lacks a solid capacity market. Do you want to explain what the distinction is between those things, and if that's the right category to have?
Yeah, sure. There's for power grids everywhere except for ERCOT in the U.S. is that there's three parts, which is capacity, energy, and ancillary services. Energy is easy to answer, right? It's just the energy that's being provided to kind of meet the real-time demand of load. Ancillary services is essentially enough generation or load resources available that can manage for contingency events or kind of the shifting behaviors of grid intraday, so that they're not going to have a drop in frequency, and so managing those contingencies. And the third one is capacity. And so capacity in regions outside of ERCOT is a market where essentially you want to make sure that you have enough generation available to meet the peak load. And essentially it's if you're a generator, say in one of these other ISOs, there's going to be an auction marketplace for your capacity, and it's essentially a guarantee to say, we are going to pay you generator A in this location $50,000 per megawatt year of capacity that you are going to be able to have available. In exchange for that capacity, you need to make sure that you're available when we have these events for certain types of weather events, and you need to also, in exchange for this compensation, is that you need to be offering your power at your marginal cost of energy. You can't have a marginal cost of 50 and say it's 200, because you're saying here's a payment for you to make sure you're available, and when you're available, you're offering it at your marginal cost with some type of small variance around that. Texas is different, and it's very similar to my home in Alberta, which is we have an energy-only market. And so what that means is that there's no guaranteed capacity market for just showing up. And Texas's kind of view on this, and same as Alberta, is the best cure for high prices is high prices, right? And so by having high prices, you're incentivizing generation to be available so that they can capture this, and it really will incentivize the generation that's participating in these to be available because they're participating in those high price events, right? So ERCOT doesn't have a capacity market, and they'll have the price signal that generation is able to say, okay, I want to build something because I see the price signal and I want to be available, and my economics can work for it, work out in that space. Whereas in other markets, it's guaranteed to the generation. On a side note, tying into kind of Bitcoin miners in Texas, and why is And I mentioned like 21st century workloads is like, highly flexible, for the most part, location agnostic from some of these other workloads. And in Texas is that normally on a power bill, the capacity charge as it relates to energy can be something like 10 to 20% of the bill, right? Just for having to pay for that. So it's a very meaningful amount. And so if you are like a Bitcoin miner going to some other market, there are programs for you to kind of avoid capacity market costs by participating in certain programs. But for the most part, like that's an additional cost. Where you come to Texas, and since there's a energy only market, the fact that you're turning off for the high price hours is essentially you avoiding capacity payments, right? So the signal is right.
Yeah.
Right. Generation, there's a high price, so bring your capacity online. Load, it's a high price, bring your generation, your demand offline. So you're actually bypassing that cost that would show up in some other market that you may or may not be able to avoid. In Texas, it's a product of the high price that you're turning off. So essentially, you're removing yourself from the capacity, costs in Texas.
This after this past summer here in Texas, where we did see a lot of high prices, there was some journalism about essentially ERCOT putting its thumb on the scale of over procuring ancillary services in order to take away from the energy market and to drive up prices there. Do you think that was a little bit too cynical, or that there's some truth there?
So every ISO has an independent market monitor. And so in ERCOT, it's a company called Potomac. And they essentially report on how the grid operator is performing and what they're doing well or wrong, or, it's guidance over kind of how's this market operating. So this has kind of been the opinion of folks, Potomac specifically, is that ERCOT has been being on the safe side, right, with what happened in Winter Storm Uri. So maybe they're over procuring to kind of make sure that there's enough generation resources put aside and online, which could result in higher ancillary services. But there's this, these reports come out annually, and there's always back and forth and kind of these stakeholder groups on, because in ERCOT, every stakeholder is represented, right? And so like there's representation from like industrial large loads that are on there. There's large flexible loads task force that's always represented. And so for these additional costs that would show up on somebody's bill, there's a natural pushback on saying, do we really need that because I'm paying for that?
Yeah.
Right? But going back to your question, was ERCOT over procuring? Is like, the market monitor thinks that they were over procuring, and there's always this balance back and forth. But we had a reliable grid, right? And so
it's kind of this dilemma of it's an insurance policy, and you might feel like you're throwing away money by having an insurance policy if you don't need to actually call on it. But then when we look at this past freeze, this kind of cold snap that we had here in Texas, which is not comparable to Uri because it was much smaller, but nevertheless, it seemed like the grid did really well going through that. Was that your assessment as well?
Yeah, it did do very well, and I was surprised actually. Like the real-time prices came out quite low, and so ERCOT every day produces a day-ahead market price, which is essentially like what is the price of energy that you can buy and sell in the day-ahead market, and then it'll settle against the real-time settlement. And the day-ahead prices came out, and I thought the day-ahead prices were actually low, and then real-time ended up being even lower. But just to compare and contrast a little bit about like Winter Storm Uri versus this one, Winter Storm Uri was a very deep freeze. It was an Arctic air that came down and sat here for 5-6 days. This was a blast that came down for a day and kind of out, right? So it wasn't comparable in the duration of that and kind of the effect. So this did very well for this. In addition, mentioned about some storage is that like an observation was that in the summertime we had $5,000 prices, and some of the work that we've done on our power desk with Lancium is we looked at this and said, looks like the batteries that were operating in ERCOT were essentially the ones that were set in price and at 5,000, because there was no large amount of competition saying, hey, we should put less because we're going to beat out this battery over here. And so there's less batteries, so call it like 1,500 megawatts ish. And so that high price cap was coming in often because these batteries are like, why would you put in $200 when if you put in 5,000, you're going to get that price, right? So like they're trying to profit seek, which is a good thing, and the market signal should be correct. So with that price signal, we've seen more batteries that are coming online, and it feels like there's more competition amongst these batteries. We recently saw this in the winter, this recent winter storm, and a lot more batteries coming online, and they weren't setting price at 5,000, right? So I think that they were, kind of undercutting. It's like you do, if one battery's like, I'll do 300 and the price is 200, they're like, okay, I'll do 195. Okay, I'll do 188. And so that's a good thing to see this competition. But again, it wasn't a really long-term winter blast, so it's hard to really say with certainty.
Yeah.
Right. So,
well,
I wanted to jump in real quick and kind of ask a question. So whenever I think of Winter Storm Uri and compare it to the winter storm that we had this year in January, to me, the big difference was the ice. And so my question is, was Uri bad because of the cold, or was it bad because transmission went down due to the ice?
Great question and super loaded question. You'll hear folks saying like, and I believe this as well, as like, to a large part, Winter Storm Uri was a natural gas story. Essentially, like if you have a winter storm and you can't get your car from point A to point B because you blame something on the tires, but there was actually no gas put in your car, like it doesn't matter about the performance of the car. There was a lack of natural gas. So there were some challenges that were happening on the actual natural gas availability for these generation assets. In addition to that, is that like, natural gas plants in Alberta are built much different than natural gas plants in Texas. Ours are kind of closed room controls, right? That like you're used to handling these very cold temperatures. So like some of these natural gas generation facilities, weren't used to kind of that type of weather. So you have lack of gas coming through. You have lack of, some performance issues because it wasn't built for that type of cold for that long. And then you can layer on as well that because the target seemed to be renewables, right? Because it's a very easy target when you can say the wind and solar didn't show up, right? Because, the wind actually didn't show up for the most part, but it was a blend of, a whole bunch of things. And to put into context, in ERCOT, I believe that in the last 20 years, there's been like 2 or 3 kind of load shed moments. And you go across all these other ISOs across the state, and there might be like a handful. It's very small, right? Like it's 5 to 10 across the country. And the way these work is that, when a grid's getting scarce on energy, they go into an energy emergency alert number 1. And that's the grid saying, we're in this alert. We have to report to what's called NERC, North American Electric Reliability Council, that we went into this status. And now we're able to pull some certain levers. We're going to call in all our demand response resources. We're going to do something with interties. And then it's going to go to level 2, which means that we're going to do something more. And it kind of differs by ISO, different grid operator. And then the third is like, okay, we're in load shed moments and we're actually cutting demand, cutting loads, right? And we're reducing the amount of load that can consume. And so the way that works is that the grid operator says, we have 1,000 megawatts that we need to cut. And the system peak at this time, say 70 gigawatts. So we have 1 gigawatt. Each utility is going to take a pro rata share of what their portion is, and then they need to cut loads within their utilities. So context for Uri is that, and I'll get the demand level wrong, but call it like 70 gigawatts. Normally a load shed is like 1,500 megawatts, right? Like 3%. You were short by a bit, right?
Marginal, yeah.
Right. This was like 20 gigawatts, right? So like, and that's what, to the point of the question, like, what was the cause, is like, there was so much to it, right? That it wasn't just kind of one cause, and it really went deep, right? And, further to that, like, folks that live down in the south aren't used to kind of having that cold. So some of the heaters they have in their home are super inefficient, right? So when you get cold, well, now you're putting on these really inefficient heaters that's really kind of sucking more power that's not normal. So like loaded question, but there's a lot of things wrong, and there's been a lot of things addressed since then, and still some that haven't closed off, but this was quite a bit different than the Uri event.
Yeah, I changed my heating source too. I went from those space heaters and then I went and I got firewood this year. So
Yeah.
I think the efficiency went up a lot. You know, I was using no electricity. I was burning wood this time around.
And you have certainty now, right?
Yeah.
You got some wood there. You know that it's like the generator is like, is this generator going to work? It's like, you know, your wood's going to work for kind of
Yeah, of course.
heating that up, right?
Yeah, there was no chances taken this year.
Yeah.
Just got asthma.
Yeah, well, more like the allergies, you know.
Yeah.
Burning wood into your house definitely doesn't help those who have allergies, those who suffer from allergies. But, you know, it was worth it because at the end of the day, I had that certainty that I would have heat regardless of whether or not the power was on. And then I'm sure I saved myself a good deal of money on my power bill of just, you know, not having to use the central heating. I used a fireplace.
I do wonder, you know, just like high prices are the cure for high prices, if outages are the cure for outages. You know, after Uri, lots of people either, you know, they got a wood fireplace, or in my case, I have a natural gas fireplace. And that's actually what kept my family warm during Uri, was having that gas fireplace. But you mentioned the gas plants, that they lacked the weatherization for their supply to make sure that those pipelines are delivering gas there. And so I think that there's been a lot of work done on that. So hopefully we don't have another Uri, but if we do, we've got a better shot than we did in 21.
Yeah, no, I agree with that. And I think there's still some open questions on, you know, for the natural gas delivery. And you know, I haven't stayed in tune with everything on that, but I think there's still some uncertainty around full natural gas delivery. But there's been a lot of steps taken to resolve that.
That brings up a question for me. Which types of power generations are more susceptible to being affected by, say, an icing event? I mean, in my head and where it goes is like, well, you don't have to have a frozen pipe in a coal-fired power plant, whereas, you know, perhaps in a natural gas power plant that might be, you know, detrimental.
Yeah. So we had a weather event in Calgary. So when you the recent weather came through here, it's like, we get the weather first and we ship it.
Yeah.
And so we had what was different about this one, and this as to kind of volatility, is that like normally we have weather that kind of creeps in and it gets kind of cold and then gets really cold, right? And this one was like, it came in, it was fairly nice, like say is like Fahrenheit, like 16 degrees. So like -5, -10. And then we shot down to -35, -40, and actually -40 is the crossover point of Fahrenheit. So -40 Fahrenheit is the same as -40 Celsius.
Yeah.
Right. And so like we shot down to -40, right? And so for our power is that we had like a scarcity event. So we went into this energy emergency, and, you know, we had a couple of generation units trip offline that were natural gas, right? And so like but prior to that, like if we get to kind of like the normal weather, like no problem at all, right? Like we can handle that. But like even in our house, is like you get to the -40, then some things start to kind of like, you know, rattle and shake. So I'd say that like if we get just something like a weather event here that's kind of like a one-day pass through, right? That's not kind of here, that's lasting, that's really kind of a deep freeze, right? These generation resources are very kind of well maintained, right? And that they're usually not at risk of having something happen like that. And they do. You know, generation resources have regular maintenance schedules that happen, call it like every, you know, 18 months, and they're taking an outage, they're fixing things. Like they take really good care of these things. But at some deep down cold temperatures, you know, they're just not going to work like they're supposed to.
Yeah. Growing up, it's funny that you mentioned growing up, my dad has worked in a coal-fired power plant in our hometown my whole life, 30 years more. And that's something that, you know, I always dealt with as a kid, was my dad had outages like twice a year during those months where demand wasn't as high. They would shut down a system in the plant and they would have to go through and, you know, inspect, replace, maintain, whatever you want to call it. And it's always, you know, been interesting that my life has been close to the power generation side, and now that I work in Bitcoin, it's pretty close to.
Yeah. Well, and being a Bitcoin company, I think, is the same as being an energy company. Right. And it's just because like so much of your business is driven by like your energy costs. And, you know, this is like, it's not intuitive for most folks, but like, you know, just the value of these flexible loads for the grid that enables you to overbuild capacity, wind and solar. So you have this buyer that can support some type of kind of the build out for these renewables, but at the same time, like a load that's super flexible that can come offline. So like it's a Bitcoin mine, I think, is like a mini power plant, but just like the reverse side of it, right? So I do think it's the same industry as your dad and a coal plant.
Yeah, it's pretty cool.
So on that note, I mean, we do hear metaphors of like Bitcoin mining is a battery or a virtual power plant, or kind of metaphors like that. But where do you think those metaphors break down of like where there are very real differences between a power generation resource and a flexible load?
Yeah, I used to use like the battery example of when it first started, and it's an easy attack on saying, well, you can't inject power into the grid, which is very true, right? And so like there's a term that's like it's a valley filler, right? Essentially, like when you have like a power system that has kind of these gaps and kind of where they're not kind of like filled for kind of the power side. But I like to use like an example for folks on like I think that we mentioned about there's the 4 flexibility kind of levers, and one being batteries and one being demand response. And so like every grid is going to need has a specific need, and sometimes the battery is better than Bitcoin for solving that problem, and sometimes Bitcoin mining is better for solving that problem. And so the example would be that like if you're up in the Panhandle, right, which can have high amounts of wind that come through for many days, right, and in Texas, there's this limitation on the power flows that come from the Panhandle that go across into East Texas. And so they're constrained on like the size of the pipe, the wires that can bring that out. And so when all the wind is really blowing for kind of, and combine some solar, right, like essentially the pipe gets full, right? Yeah. And at that point you're going to get negative prices for a long period of time. And so now put in the battery into that place and say like this is going to be 5 days of kind of wind. Well, the battery is going to charge on day 1 for the first 5 hours that are negative, and then has to wait 5 days to kind of come out when prices are negative, because if that battery re-injects that power into the grid while prices are still negative, they're actually causing further worse, right? Yeah. Right. So they're actually, not doing any benefit, right? Yeah. Whereas you have a Bitcoin mine that's essentially, they're consuming, and then like during this, high wind is like they're consuming as much as they have, right? So like you're now providing kind of a higher price floor for these renewables that incentivizes more. So you've increased that price base to incentivize generation. And then when the prices go to a certain price or higher, the mining just turns off when it gets above like a break-even price. So the use case for mining is more specific and more relevant in that use case. Mm-hmm. Where you think about like a battery and kind of like some things that were happening in say there's some intermittent price spikes that are happening during the day, right? That the battery needs to kind of be the one that can like inject power into the grid to kind of bring that down, or to providing some type of backup power, right? There's use cases of battery that like Bitcoin can't exceed, but then there's some that Bitcoin can. So it's like as a grid operator, you want it to be like an and statement, right? Like I want batteries and I want demand response. I don't want an or statement.
It was something I've noticed with batteries is that they'll buy, as you mentioned, they'll buy a negative electricity price, and then they'll sell, and I'll see them discharging at like $80 or $60 a megawatt, just because they're arbitraging, right? That swing during the day, and that is still below the break even for Bitcoin miners. So in a way, like when I look at that, I see, okay, well, batteries are powering Bitcoin miners right now, and the economics are working for everyone, obviously. I mean, I'm sure the batteries would like to have higher prices, and the miners would like to have lower prices, right? But that's a trend I've been seeing when just looking at kind of the ERCOT dashboard, is batteries are participating in the energy market below Bitcoin's break even.
Yep. And it makes sense where like, the battery economics are twofold. One is like the energy you mentioned, and a perfect market is somewhere that has really cheap prices and then some, good high prices to kind of take that time spread. And then another market is one that has, ancillary prices that are, so ERCOT is this, isolated grid. So they have to procure more grid stability products, these ancillary services. And so you're in a good market that they can provide the whole suite of ancillary services to the grid operator. So it's been a real kind of good environment for these batteries. But as mentioned, we're now seeing a whole flood of them where like, high prices care for high prices and pendulum swings. And so you're short kind of these levers. And then I think that we're getting to a point of like, I'm not exactly clear on the exact economics of the batteries on where they can't make it work. And like, is it like an energy of, $50 for how many hours per day, and like I'm not sure the exact break-even points.
Yeah.
But they're probably going to start looking at other markets now because ERCOT's now compressing that volatility, and some of those ancillaries are coming down. So it'll likely start to move around different locations.
Interesting. And the other trend I've noticed is that it's really two periods during the day. You've got like there's that morning period and then that evening period. And then in between, you've got the sun. So even if you don't have any wind, you've got sun. And then at night, you just don't have the load. And so that seems like a really good use case for a battery, that you've got those like 30 to an hour, 30 minutes to 60-minute windows.
Mm-hmm. Yeah, there has been good opportunity. And it shows up on just the amount of batteries. I think
But it's a big capital cost, right? Is that the constraint?
it is. And I think that kind of last I checked, it's about $1 million a megawatt, right? And so like you're having to kind of pay for that to say kind of what's my upfront capital to kind of collect on what I'm going to capture later. And it's easier on some of the Bitcoin economics because you can say, here's the cost of my load, my machines that are kind of be acting like this kind of flexible load. What am I going to receive in kind of like the value of a hash rate, which is the commodity, and then the real juice is saying, okay, what is this extra value that I can do for providing the same ancillary services that are being provided by other resources, but I'm doing it. And this isn't always clear to folks, is that like, generation, when they're providing ancillary services, you've got a natural gas plant, right? And it's 100 megawatts of capacity, and you can use that capacity to sell energy or ancillary services, but you can't do both. Right. And so like
with ancillary services, you're being paid to stay off until ERCOT wants to deploy you.
That's right. So assume you're like 100 megawatts and you've sold 80 for energy and you have 20 that you've put in ancillary. So you're running your plant at like 80 megawatts. And so you're getting paid for the ancillary services, but you're not getting paid for the energy because you have to wait for them to call on you. And if you do, you'll turn up to provide that. Whereas in Bitcoin mining and other flexible loads, is that they're actually getting paid for the ancillaries to consume, so that the behavior they're doing is no different, but they'll be called on by the grid operator to essentially turn down the same way a generator turns up. So like these flexible loads have the benefit of it's not an and statement. It's like the other ones have an or statement. Where mining is that you get to consume energy and provide the ancillaries at the same time.
Yeah, it's funny when the critics of Bitcoin mining say, "Oh, Bitcoin miners are being paid to turn off." Like, yeah, but like generators are paid to turn off as well. So it's just part of the engineering of the system is that the ERCOT needs to have that level of control.
Yeah, and I think something that's sometimes not as clear to folks too is that you'll see headlines about miners that are getting paid for turning down or certain revenues, and like going back to kind of the energy and the ancillaries is like in ERCOT, like ERCOT doesn't pay any generator or any load just to turn off during high prices, right? What they do is they say, well, if you've turned down, like you're just not buying the energy, right? And on the ancillaries is like, for Riot, as you participate in these ancillary service markets, is like you are competing against like the whole suite of resources out there, and that you're going to get paid the same way that these other resources are getting paid. And so ERCOT will pay you for this reliability product that they're procuring from you. And then, for companies that have like an energy hedge, right, that they actually, say they bought like a fixed price energy hedge for, $50, and then they turn down they're essentially getting paid to turn down by their energy supplier, right? Because their energy supplier gave them a fixed price contract, and it was based on, take or pay. And if they turn it down, they're going to pay them what the real time price was because they're exchanging a fixed price for an index.
Yeah.
So it's that difference of, getting paid to turn down, because when miners enter these energy supply agreements, like it's not riskless,
Right.
like it's not a guaranteed.
The price could go up or
Right.
down. And you mentioned earlier, if you got negative electricity prices, but you're in a contract that's at $50 a megawatt, you pay $50 a megawatt. You don't magically get out of that.
Totally. Yep. And the analogy I use is kind of like, it's like your neighbor pre-COVID, start of COVID, went and got like a 30-year mortgage for 2%, right?
Yeah.
And by the way, at that time, like it didn't seem riskless. Like there's a lot of stuff going on, right?
Yeah.
And then, interest rates go to 6, right? Like, so they're benefiting by this shift, right? But that could have gone down to, 1 or 0.5. So like it wasn't a riskless thing. And so the same with, companies like yours that have had like energy hedges, And, it wasn't a guarantee that the price would go up. Otherwise, the price that you would have bought at the start was like, it would have been a higher price, right? So like when you enter these deals, like that is the market price, and it could go up or it could go down. And so like the only way you actually make money on these long-term contracts in the long run is that like if the price actually settles above where you bought them on average. So yeah, it's definitely not riskless, and it's not free money, but it's definitely something that kind of adds to kind of the revenues when you turn down if you do these contracts.
Right. And the energy producer on the other side, why are they entering into the contract, right? Because that's the other thing, is that people will say, oh, these Bitcoin miners are getting a sweetheart deal with their energy provider. And I'm like, well, these are for-profit companies that are also trying to profit maximize. So there's no like sweetheart deals. It's a very competitive market.
Very much.
So what's in it for the power generating company to enter into a PPA?
Yeah. So I mentioned the company I worked for, where you went from regulated guaranteed pay to deregulated. And what you're trying to do is that you want to have like sustainable earnings, right? So you have power generation, that you have these assets that can produce power for 25 years. And shareholders want to be betting on the power company's operations. When somebody invests in power companies, typically they're not betting on power prices, they're betting on the operator and their ability to monetize that asset and kind of bring value. And so what they want is have like stable, predictable earnings that go through. And so when they enter the contract, is like they're going to go to market price and saying, if we do nothing, right, we don't sell to anybody, we're just taking the index price, which means that we're going to generate power. We're going to sell it into the ERCOT, and ERCOT's going to pay us the price at our node for that power. And you're taking your whole portfolio at the node price.
Yeah.
Right, which is not going to fly.
No.
but there's very few companies that have a model that's purely merchant, where investors can say, I'm betting on electricity prices.
Mm-hmm.
Whereas, a company that would sell to Riot would say, I've got this generation, and at the time when you're entering the contract, I'll use examples like, we're going to sell Riot $50 power for 10 years, right? And they know what their cost of generation is. And we talked about heat rates.
Mm-hmm.
And they say, well, I'm going to source it off this plant that has an 8 heat rate, and gas prices are $3. So I'm going to go out and buy all my gas for this, lock in a $24 cost. I'm going to have some operations and maintenance costs, O&M costs. So my cost to produce is $30, right? And then I'm going to give you a fixed price of 50. So they're not making that much, but they're going to be collecting some additional margin on that. Mm-hmm. But they're locked in, right? And so their investors are happy. And then when you go and turn down, is that you have this $50 guarantee from them, right? Is they're going to pay you index because they're injecting their power to index anyways, right? So there's going to be this natural continued locked dollar amount that they're getting over time. And so that's the benefit for them. They're happy now they got like sustainable earnings. Their investors say, okay, this is great. You're getting good margins. You're a good operator. For Riot, you say, I got a $50 hedge. I've got certainty on my prices, right? I know how to operate these. And plus I'm going to get more value of this because I'll be able to turn down for certain hours. So there's some upside if the power prices go up, right?
Yeah.
But if they go down, at least I'm guaranteed that this locked price, and you have certainty around that.
That is fascinating. And do they use those PPAs to make investments, essentially of saying, okay, well, we locked a 10-year contract. Now we need to build a new power plant because, this is going to help us with financing.
They would love to have somebody come to them and say, build me a power plant. I'll sign a 25-year offtake. Your cost to produce is 30. I'll pay you 40.
Yeah.
Right. And so the challenge is that like the majority of power consumers are short-term window, right? And so think about like your retail contract at home. Like mine in Alberta is 1 year fixed price I've signed up for, right? So like nobody in a retail contract wants to sign for 10 years, and if the power company's signing with you, they don't want to stomach the credit risk of you just defaulting, walking away.
Right.
So there's very few industrial customers that can actually sign a very long power contract, right? Because there's also the collateral that needs to be posted around that. But power companies would love to build you a power plant and just clip the coupon and saying, I built the power plant, my cost was this, we put on some adders, cover my capex, and I've taken this offtake. Who's next?
Right.
Right? Like, so they'd love that. Yeah.
And it's interesting, at the retail level, people look at their power bill and they'll see 12 cents per kilowatt hour. And in megawatts, that's $120 a megawatt, which is and then they look at a Bitcoin miner and they're like, well, a Bitcoin miner is getting, let's say, 5 cents a kilowatt hour. And so that's where they're like, well, why are they paying so much less than I am? But as you mentioned, if the price of electricity were to go down, that retail person would have to post collateral. They've got 48 hours, wire $10,000 to your electricity company to keep the power on. They're comparing apples to oranges.
Completely. And I'll use an example on that. It's like, so your power bill as an industrial customer is that for the most part, you're consuming flat. You're turning down for avoiding these high price hours, right? Whereas a retail contract is, pretend you're consuming 1 megawatt around the clock. For the retail contract, there's two parts of the bill that really change kind of the value, and they're on the energy and the transmission side. So on the energy side is that in the morning, they're only consuming 0.25 megawatts.
Yeah.
Right, in the cheap times. But in the daytimes, when it's more expensive, they're consuming 1.75. So they might average 1 megawatt, but their consumption is super low during the cheap hours, a lot more during the high price, because this is matching kind of the supply and demand side. So they're going to have a higher energy cost because their consumption is way more
correlated,
with the high price. And second is that the way transmission costs work is that you pay for your transmission based on your peak consumption for that month. So,
which makes sense because the transmission needs to be sized to that peak.
That's right. So like as a Bitcoin miner, since you're consuming a megawatt all the way around the clock, that dollar per megawatt hour, if you want to calculate, would be say $7, right? But with the retail load that's consuming up here for this peak part, they got way less megawatt hours to compute. So like their number for yours was like 7, but theirs shows up as like 25, right? Because they have to pay for that peak capacity, but they're not actually using power all the way through where the industrial customer is. So like there's a huge disconnect. Folks think that there's way more advantage to be an industrial customer. And an answer to that is they're more than welcome to consume around the clock, similar to like these industrial loads. And they can mirror the rate structure for the most part as another industrial load.
Yeah, it's like, do you want to be a night owl, like doing your laundry at 3 a.m, so that you're shaving your peak? And then also in Texas, I mean, it's about air conditioning, right? It's like, okay, well, how much do you want to invest in insulating your home versus paying your power bill? Is kind of the trade-off that you'd have to face. And then the comfort level. Do you want to be at 74 degrees or at 84 degrees in your house during the summer?
It sounds like we need to have air conditioned units with their own batteries.
That, you know what? If you can afford it, you can get a Tesla Powerwall. You can be energy trader from home.
Yeah.
Do you know what? It's like we've got a place in Montana that we just bought a parcel of land, and we're developing it. And it doesn't have electricity. It didn't have electricity, right? And then, you think about all of these options on what can I do to get the electricity? Could I put some solar panels? Could I do like a smaller generator? And at the end of the day, like we had to pay like quite a bit more because we had to go like a long distance trench kind of, the wires down to kind of our lot. And like, it is far cheaper to using the kind of the power that's produced by the utility company than to go your own path. So like all these kind of like unique solutions that you kind of like, fiddle away at is like usually the cost benefit it's much higher cost than the actual benefit you're getting. And like this utility solution is just like, we are super fortunate to have 24/7 reliable power. You go to different parts in the world and that's not the case, where there's just regular rolling outages. And so like
it's like economies of scale, right? That, hey, even a solar farm will just have far greater economies of scale than putting solar panels on your roof. Although I got solar panels on my roof after Uri, I was like more of as almost a backup, right? I've got 2 power walls, the solar panels, and now I had a friend who was like, "Hey, you need to get a Generac too." I'm like, "Okay, hold on. Like my power bill is already twice what it was before Uri because of I'm adding this luxury of." I've got little kids. I want to keep the power on, even if something happens. But it's not. I thought it was going to be a cost saving going into it. Coming out of it, I'm like, no, this is definitely adding to the cost.
Well, I think what's pretty cool is that coming from Calgary, it's like an oil and gas town, like similar to what Houston was before. It's more diversified now, but like in Calgary, like power was never on vogue.
Yeah.
Right. And it feels like power is definitely on vogue and people are talking about it because you see it front of mind, right? And so like, yeah, it's neat that everybody is now aware of it. People are saying like, you have a generator at home or power walls. And so like people are finding all these solutions. So it's really neat to see kind of this, transition happening and just people aware of, kind of power and the importance of power and the importance of, these, the narrative is now shifting on these, flexible loads like mining is like the significance and importance of them in this transition, which I think is a pretty big deal. Yeah.
How are we doing on time, Gabe?
We're closing in on about an hour right as we speak, actually. Just to close out that thought, and you guys mentioned it yourselves, is like the stark difference between the United States power grid and those of other countries, and how now all of a sudden, because of these winter storms, that the power generation, the power grid is on the front of everybody's mind. Well, imagine how much it would be on the front of your mind if you lived in another country that had rolling blackouts daily.
Yeah.
Like it's pretty insane. I mean, I wonder if their entire lives are consumed with thinking about power, or they've just lived with this for so long that they don't even think about it. They just say, "Oh, there goes another power out."
I've talked to somebody on a podcast before where he was from South Africa, and they have like the same way you kind of like you buy minutes on a phone, like they buy kilowatts, right? That actually plugs in a code for their meter and what they get. And in his area in South Africa is that like there's a scheduled window for when your outage is, and it changes every week. So everybody's paying attention to it. And so now it's, when we did the podcast, we had to kind of shift the time to where he had certainty that he was going to have power, but like it's normal for them now. It wasn't not too long ago, but like, that's just kind of like a way of life. And, imagine in Texas, if there was a rolling schedule that 2 hours per day that, people had no power, right? Like
It's unimaginable.
Right?
Yeah.
Yeah.
So very thankful to live in the world that we do, or on this side of the world, at least.
Yeah, in the political environment in Texas is already, just because of Uri, there's a lot of people who kind of focus in on, hey, we got to fix the grid. Like the grid is broken. Yeah. And it's like, well,
compared to what?
Yeah.
Yeah.
It's, yeah.
And maybe I'll just kind of tie in like what I do at Lancium.
Oh,
yeah.
Well, so yeah, I did want to ask, we talked about ancillary services and ancillary products. I wanted to ask like what those products are and how Lancium software fits into that matrix.
Yep. To start with, like what we provide is it's an integrated platform, right? And so it's part software, part hardware, part people. So essentially kind of, having a power desk as well that's looking at power markets. And what we do is we work with customers to essentially, the same way like a power generation company would have somebody that's responsible for kind of like how do you dispatch the plant into to the grid for the maximizing the revenues and the equipment that's on these kind of plants for turning up and down is that we do that for, this emergence of these 21st century workloads, miners, electrolyzers, Bitcoin mining, and also do advisory services and helping them kind of figure that out. So what we do then is, we have the ability, we have our IP that we use with certain customers that allows you to kind of convert your load into essentially a resource that is now sched dispatchable by a grid operator. And why that's really important is that like, the same way a grid operator has visibility around like a generator and exactly what is their output at this exact moment, now they have these, controllable loads that you can see exactly what their output is exact moment to know that they're actually delivering and performing at that time, right? And so what we do is, we work with, these different customer types to really understand their business model, and we provide, guidance, advice, and they're the ones that are the decision makers on what to do and how to actually, make those decisions. But we're helping them with delivering the lowest all-in cost for their energy, and which is also the benefit for the grid, because if you think about if a gas plant is being super efficient how they're operating in the grid, they're providing the lowest cost energy, they're providing ancillary services, so it's a big win for the grid the same way for these flexible loads. So tying into like the ancillary service products is that there's a few different products in ERCOT. One of them is specific to ERCOT, which is RRS, Regulating Reserve Service, and that is like the frequency product, right? Mm-hmm. And that is essentially, we recognize we're an islanded grid, right? And most other ISOs, all ISOs, don't procure this RRS type product because there's enough generation in the entire interconnect that if something went offline, it's absorbed by the kind of the denominator of the generation in those areas. right? So in ERCOT, they need to procure this RRS, and so for the controllable loads are able to participate in the full suite of all ancillary services in ERCOT. And for this one, was very much a premium product before.
Because it's such a short time frame that you have to be responsive on.
That's right. It's kind of like if you think about like ancillary services as like, different types of cars, is like RS is like the race car, and then like non-spin is kind of like the
diesel truck.
Yeah, that's right. Right. And so like it needs to be super responsive and reliable and automated. Right. And so that, for example, if a frequency happens, within milliseconds, right, you're actually changing the consumption of your load to drop to that frequency, right, that's in relation to the amount of load that you have, and your response is expected, so that you're kind of addressing that frequency shift on the grid, so that you're able to kind of stomach those kind of contingency events and to be able to provide that kind of support until they can call on additional generation, right? So it's like you need this immediate response. And so that's the RRS.
I'm sorry, is that a response to a signal from ERCOT, or is it a response from the monitoring of the grid by the software?
By the software. So it's automated. So it happens so fast that you can't actually just wait for the grid operator to say we need you.
Wow. Okay.
Right. And so this is why generators are good at this, because they're spinning mass that can automatically make those changes. And so miners as well is like you got to detect that there's been a frequency change, make that drop, and then the way that ERCOT audits you to make sure that they go back and say, hey, there is a frequency event. Let's observe what you did for kind of how much you came offline. Okay, good, that you met the requirement for what you were supposed to do for qualifying as this type of load in ERCOT to resolve that.
I see.
Yeah.
That's fascinating.
Yeah.
The longer time frames.
Yeah. And the other ones are like, there's two other classes. One is just called regulating, and this is all ISOs, and essentially like a grid operator is going to make a mistake every 5 minutes on just under on how much generation they brought online. And so they need to have this ability to actually control the generation by sending like 4-second signals to them, to saying, hey, turn up a bit, turn down a bit, because we missed forecast. So this is called reg up, reg down, right? And so this is kind of like, hey, we need a little bit more, a little bit down. So that's the regulating. And then the contingency reserves are essentially what happens if something trips offline, right? And so and there's different classes on how fast you need those.
Yeah.
We call those ECRS as a shorter time frame, and non-spin is 30 minutes. So there's all these classes of ancillary services that are, the first class is the frequency, and the second one is how do we manage that contingency after we address the frequency.
Yeah, and I think what they were deploying during the summer when you had the sun setting and the solar was ramping down was ECRS?
Yes, yeah. So ECRS has also been used for the ramping hours, right, to make sure that they can kind of handle the ramps.
Yeah.
So it's a multi-use product for kind of the ramps plus also contingencies.
Which is astonishing, because it's like 12 gigawatts of solar, I think, is where we're currently at, and just seeing that ramp up or down, and within an hour time frame window, and the grid needs to like navigate that in real time. And then on the wind side, I have a background in sailing, not professionally or competitively even, but just let's call it recreational sailing. Yeah. You've got puffs of wind that'll blow in or out, so it's like that's if you're relying on wind, that's going to add some variability that then on the load side or in some mix of the generation portfolio needs to be offset.
Yeah, very much. And a product that an upgrade to an existing product that affects miners I'm excited for is that there's an NPRR, which is a protocol rule revision in ERCOT that's been accepted, and they just need to implement it, and it's for non-spin CLRs. And what it allows you to do is that if you can sell this non-spin ancillary service, but if the price goes above $75, you're able to turn off yourself, an auto turn off, right? So what does that mean is that currently as a flexible load is that if you've sold an ancillary service, like you need to be consuming energy at that point so they can call on your energy, and you have to wait for the dispatch from ERCOT to provide that. For generation, for when generation has this non-spin, and I think I mentioned this when we were talking at a conference before, is that you'll see this $75 price point, right? And a whole bunch of generation around the $75 that is available. It's because like for generation, you can sell this non-spin, right, and collect on that. And then if the price goes above $75, right, you can actually dispatch up and be called on. So you can, self-select to be called on, and then you're online for 75. as a controllable load right now is that you're not able to do that. You have to wait for ERCOT's direction to turn offline. But once they actually, implement this through the systems at ERCOT, you could sell a non-spin, and then when the price comes above 75, you can turn down.
Because in the status quo, you're taking on some price risk of, okay, we're at $300 a megawatt, but ERCOT has not called you yet, and so you're kind of eating that loss. And
That's right.
now you factored it in when you were bidding into ancillary services, but what you're saying is that with this improvement, there won't be that disconnect.
That's right. Because you get people sometimes say is like, your facility was online yesterday and prices were $500. Why? Right? It's like, well, we didn't think they were going to be 500, so we participated in the ancillary services, and with the rest of generation, we're providing these services to ERCOT like these other generation resources, and we're only getting paid $100 per megawatt hour for mining, and we're paying 500, so it's not so good.
Yeah.
Right? But we're providing this service for the grid operator, and we can't come off until they tell us to do so. And this other outcome is that you can actually provide that service, and then when the prices go high, you can turn offline. So you actually turn off, and you can still receive the ancillary service for that. So you're compliant to that.
And is the thinking there is that because the energy price in real time has gone to that level, that we do need to have some, I guess, in my mind, then it gets into like, is non-spin really about reliability, or is it about keeping prices low?
Yeah, good question. And I read the Potomac kind of state of the market reports every year to kind of hear what they're saying. But yeah, it is a bit of kind of a price on that, right?
I find it fascinating that all this stuff is going on in the background and nobody has any clue. Like, the layman person would have no idea that every 30 minutes, every 4 seconds that these things are ramping up, ramping down. It's incredible.
Yeah.
Yeah, imagine if you turn on the light switch and it's like, hey, you have to schedule that with ERCOT. You have to say, hey, at 9 a.m., I'm going to turn on my light switch so that you guys are ready. And that's what SCED is basically like, is giving that visibility to ERCOT.
That's right. And one other kind of thing that's in the pipe that I think a lot of miners are excited about is that all loads across Texas pay zonal pricing. And there's kind of 4 major zones across Texas, like west, north, south. And you're going to pay essentially the average price across that entire zone for your price. Whereas, generation gets paid at the exact node, right? And the reason for that is that you want to have the right price signal to say, power prices are very expensive over here. We need generation over here. So the node should be expensive to kind of attract, generation to come there. We're now at a point where these, very fast growing kind of flexible loads are like, they can choose their location, and they can actually go to a location that could actually be a hindrance on the grid because the signal is at the zonal level, right? And so the shift to actually having these controllable loads receiving nodal prices is a big deal for 2 reasons. One is it is a signal that's the same way for generation, right? So it's saying, hey, there's cheap power up in the Panhandle, or there's cheap power down here in the south. You should go locate next to these nodes because there's an abundance of cheap energy, right? Yeah. So
and vice versa. Stay away from these nodes if they're expensive.
Yep.
So it's kind of realigning the physical reality with the financial reality, right? So that the incentives are
That's
working
right.
well.
Yeah. And so with a load zone price, especially in the west, right? Like you can have the west load zone at $100, and there's these nodes that are at like $3 and $5, right? So it's going to be a big benefit for getting these kind of loads exactly in the right location for them, and then getting the benefit of price, right? That you're getting cheap energy.
Yeah. The grid is constantly improving. It's fascinating. Yeah. Shaun, well, thanks for coming on. This was really a fantastic deep dive. I think we could probably keep going for a couple of hours, but hope to have you back on soon, and we'll keep peeling the onion here.
Thanks for having me. Appreciate it.
Thank you. And we'll see our audience again next week. Please leave a 5-star review in your favorite podcast directory. Subscribe to the YouTube channel. And also check out Lancium's YouTube channel as well. They've got some really great content up as well. This has been fascinating. Hope you found it as interesting as I did. And we'll see you again next week. Thanks for tuning in.